Good evening. Thank you, everyone, for coming to tonight's program. I'm John Smalley, a librarian with the Humanities Center here at the main library. Before we get started, I want to acknowledge our community and say a few words about upcoming programs later this week. On behalf of the public library, we wish to welcome you to the unceded ancestral homeland of the Ramaytush Ohlone, who are the original inhabitants of the San Francisco Peninsula. As the indigenous stewards of this land, and in accordance with their traditions, the Ramaytush have never ceded, lost, nor forgotten their responsibilities as caretakers of this place. As guests, we who reside in their traditional territory recognize that we benefit from living and working on their homeland. We wish to pay our respects by acknowledging the ancestors, elders, and relatives of the Ramaytush community, and by affirming their sovereign rights as First Peoples. So, as some of you probably know, this evening's presentation is part of Everybody's Climate 2025, which is the library's month-long series of programs on climate change. A series that we hope will inspire you to act for a safer, greener, and more sustainable future. I want now just to mention a few of the upcoming programs. This Thursday at 4 p.m. in this very room, the philosopher Jason Wirth will be giving a talk, Humanity in the Anthropocene. He'll be asking, and the Anthropocene is the name of the era, the name the scientists give to our present era, an era shaped by human activities. He'll be asking, what does the Anthropocene reveal about our humanity? Might this be an opportunity for thinking about humanity and the humanities? A week from today, next Thursday, 12 p.m., also in this room, we'll be screening two short climate documentaries, Climate Crisis Drought and Food for Change. These documentaries examine the sort of extreme drought conditions that are taking place in the world as a result of climate change, and also efforts to transition to a new dietary model. Lastly, next Thursday at 6 p.m., also in this room, we will conclude our series with a multimedia performance, music and poetry, The Jingwei Bird, which features the Del Sol String Quartet playing new music by Asian composers, and with the participation of San Francisco's poet laureate, Jenny Lim. So I hope you will come back for that program. If you want to learn more about our programs, you can always visit our website, sfpl.org/everybody'sclimate, or you can pick up one of the blue booklets on the coffee table to your right, where you will also find coffee and cookies. Help yourself. Also above the table, there is a QR code for event feedback. Before you leave today, please do capture the QR code and give us your thoughts and suggestions. We love your feedback. So I think this concludes my announcements about upcoming programs. There will be, after today's presentation, a Q&A with our presenters, so I hope you will stay for that. And now let me just say a few words of introduction before turning the microphone over. So this program, I believe, is entitled, Climate Change is Fueling the Insurance Crisis, Who Pays? Our two presenters are Chelsea Lindsay and Corey Riday-White, and they both work for the Center for Climate Integrity, which is a nonprofit organization that supports communities in their efforts to hold oil and gas corporations responsible for deceiving the public about their harmful products. Chelsea Lindsay is Senior Staff Attorney with the Center for Climate Integrity, and Corey Riday-White is Managing Attorney as well as Legislative Counsel and the Head of Legal Outreach. They're both marvelous presenters. We had, some of us had the good fortune to hear them earlier today, and we're glad they came to assist us this time. So please give a warm welcome to Chelsea Lindsay and Corey Riday-White.
Thank you. And thank you, John, for the warm introduction. We're really happy to be here. I can't say that it's a rosy topic, but we're happy to have an audience that wants to engage with us around it. This is really what we do at CCI. John is right. We support communities and folks who want to hold the oil and gas industry accountable for decades of deception. We have this very narrow focus, but within that narrow focus, we have a lot of capacity on our interdisciplinary team to work with lawyers and lawmakers and scientists and researchers and comms folks so that we can tell this story and seek accountability through the courts.
So today we're going to talk about how the climate crisis is driving an insurance crisis. To tell you this story and walk you through this issue, we'll start by explaining the problem about how the climate crisis is creating an insurance crisis. We'll talk about the cause, the reason we have a climate crisis, and the reason this is happening. And then we will talk about the path forward. And like Corey said, talk about making polluters pay. So I will start by introducing the problem. So due to climate change, global temperatures are steadily rising. 2024 was the hottest year on record, and it was the first year that the world temperatures, average temperatures, exceeded 1.5 degrees Celsius over pre-industrial levels, which is a key threshold for limiting the most harmful consequences of climate change. This warming is driving an increase in extreme weather. We are having more destructive wildfires, heavier rainfall, stronger storms, and heavier drought. One of the most important ways that we protect ourselves from disasters like these is through insurance. We purchase insurance as homeowners or as renters. We pay companies annual or monthly premiums in the event that we experience major disaster so that those companies will then reimburse us in the event of that disaster. This not only helps us as individuals and as families remain financially solvent in the event of a crisis, but it also plays an important role in society in keeping communities resilient and helping communities recover after a disaster strikes. This mitigates devastating harms to the economy that can occur in the aftermath of a disaster. The way that insurance is priced is by risk. So if I have a relatively low risk of experiencing a disaster, then I pay a lower price for insurance. If I have a higher risk of experiencing a disaster, then I pay a higher rate. But how do insurance companies know what your risk is? Insurance companies assess risk for events like wildfires and floods and hurricanes by analyzing historical data, usually the last 100 years of historical data. And the underlying assumption is that the past is going to be a reliable predictor of future risk. But this is no longer true. As you can see on this slide, this is the global average temperatures over the last 175 years. Climate change is accelerating. We have a big shift starting in 1980 and through the present day. And with this acceleration in climate change is an acceleration in the extreme weather that we've experienced in recent years. This slide shows the number of disaster events causing over $1 billion in insured losses each year since the 1980s. This trend is increasing dramatically. So because of climate change, past data is an increasingly poor predictor of future risk, which creates a problem for insurance companies. There's a resulting mismatch and a growing mismatch between how risk is priced by insurance companies and the damage that's actually experienced by communities. So this has really serious consequences both for insurers and how they price insurance for you and for the communities and folks like you and me who rely on insurance companies to keep us protected. Let's look at some facts and figures about climate disasters. Like Corey said, not the most rosy topic. This year, Bloomberg reported that the US has spent, in the last 12 months ending in May 1st, over $1 trillion in disaster recovery. And that includes post-disaster repairs, that includes insurance premiums, and that includes federal aid. Insured losses from natural disasters in the United States now routinely approach $100 billion every year. This compares to the year 2000, when the average was $4.6 billion. And you can actually see that in a graph on this previous slide. There's a black line here that shows you global averages, or the 5-year average over time. So you can see this black line is steadily going up and is now routinely in the hundreds of billions of dollars. In the 1980s, the US suffered an extreme weather event that cost $1 billion every 4 months. Now, one is happening every 3 weeks. Even in 2023, which was a pretty quiet year for hurricanes, which we know are very expensive, there were a record-breaking 37 events that each cost $100 billion. So it goes off the chart here in 2023. In July of 2023, 60% of the population was facing an extreme weather alert, to give you a sense of the extent of the risk. This year, in 2025, the US has suffered 15 separate billion-dollar weather events during the first half of 2025, as of today. The total has been $84 billion in insurance losses in just the first half of this year. The Los Angeles wildfires in January accounted for about $40 billion of that 84. Insurance companies are calling this a new market reality. And people like you and me are the ones who are paying for it. First, we're paying for it in the cost of insurance. So between 2021 and 2024, the average homeowner saw their home insurance rates rise by 24%. In that time period, home insurance rates increased in 95% of US zip codes. In 1/3 of US zip codes, insurance premiums increased by over 30% over 3 years. From 2021 to 2024, the annual average insurance premiums for a typical homeowner increased by an average of $648 a year, which is a pretty significant sum for people who are trying to budget. And this doesn't just affect homeowners. The rising cost of insurance affects all property. It's passed on to tenants in the price of rent. And it makes the cost of owning a home harder and further out of reach for folks who are trying to realize that American dream. Another way that everyday people are paying for the price of climate change, the climate crisis, is through non-renewals. An insurance industry survey found that today, 12% of Americans can no longer get home insurance, which is up 5%, or it's up from 5% in 2019. So in the last 6 years, we have seen a doubling in the number of people who cannot get insurance. Here in California, between 2019 and 2024, more than 100,000 Californians lost their home insurance. And according to this analysis from the San Francisco Chronicle. As you can see in this graphic, a large number of those non-renewals are in major metropolitan areas like Southern California, the Bay Area, and Sacramento. A new crop of non-renewals has also taken place in 2025. There might be some other folks here who, like my husband and I, also lost their home insurance this year. So that's one way that we as everyday people are paying for it. So what happens if you lose your home insurance? When homeowners lose their homeowners insurance in the private market, some states, like here in California, offer a state-run insurer of last resort. Here in California, that is known as the FAIR plan. It stands for Fair Access to Insurance Requirements. About 2/3 of US states have FAIR plans, fortunately, and their enrollment is increasing rapidly. The state of Colorado, due to wildfire risk, had to launch a FAIR plan, brand new this year. They did not have one before, but so many people are losing their home insurance that to protect their homeowners and the people of Colorado, they have started one. In California, as of June 2025, the FAIR plan has about 600,000 policies in force. which is a 31% increase in the number of people on the state-run FAIR plan since 2024. And it's a 154% increase since September of 2021. So it is growing dramatically year over year. The reserves for a FAIR plan, so if you're on a FAIR plan and you have some losses, they have to cover your losses, right? So where does that money come from? The reserves for the FAIR plan come from the premiums that people pay into it. So often these premiums are higher than in the private market, and the coverage that they offer is lower. And this is in part because they're providing insurance almost to exclusively high-risk properties that have been found to be too high risk to be covered in the private market. And because they cover high-risk properties, that means that the plan's risk of loss is really high too. So there's more and more high-risk properties coming onto the FAIR plan, which means that there's a greater exposure and risk of insolvency, which has meaningful impacts to the state. In California, the FAIR plan's total exposure is about $650 billion. So there's a risk that the FAIR plan could lose about $650 billion based on the risk of the properties that are in this plan. You can see these are each previous year for the last 5 years. The risk of the FAIR plan has grown almost 5 times in the last 5 years. So what happens if the FAIR plan experiences a loss that it can't cover? Here's what happens. So when the FAIR plans in states like California have to pay out more money in losses from a disaster than they have in their reserves, then they turn to the private insurance companies doing business in the state and say, you all have to cover this. So they kind of socialize the risk. Those costs are then passed on to those companies' existing customers in the price of their insurance. So this isn't just a problem for everyone, or this isn't just a problem for people on the FAIR plan. This is a problem for everyone who has insurance in the state. And it's not just the price of homeowners insurance that could be affected by FAIR plans. In Florida, the FAIR plan can assess emergency assessments on the state plan, on their insurers, and those insurers can assess their auto insurance. They can add assessments to their boat insurance. They can even assess emergency assessments on pet insurance and increase all those lines of insurance by 10% in order to cover the reserves for the FAIR plan. So it's not just these folks, it's not just the folks who've lost their insurance or are now on the FAIR plan who are at risk, it's everybody who relies on insurance in the market. So also, because those private insurers are on the hook, so in California, we turn to the private insurance market to cover these losses. Since those companies are on the hook, overexposure in the FAIR plan can spook insurance companies. They can look at their market share and say, oh, we have too big of a market share here in California. Maybe we should drop some people so that we're not liable for as big of a loss if this FAIR plan that's overexposed goes bankrupt. So that's another way that this really affects the dynamics of the insurance market and really what is causing a domino effect and the insurance crisis that we're experiencing in California. So it's a little bit of a race to the bottom. So that's why this year, our insurance commissioner here in California actually put a cap on the loss that insurers can be liable for in the event of a FAIR plan shortfall, which is good for stabilizing the insurance market, but what does that mean for the rest of us? Where is that money going to come from? Well, it's going to be assessed on all of the policyholders in the state. And so that is one of the things that is continuing to drive the insurance crisis and how you and me as folks here in California are paying for it. The final risk to everyday people from the insurance crisis is through the risk of a mortgage crisis due to dropping property values. The homeowner's insurance is required to get a mortgage. So when folks can no longer get insurance in the private market, it puts them at risk of defaulting on their mortgage, which is one of the reasons why the state of Colorado has said, well, let's get you a FAIR plan so you have some insurance and you don't have to lose your house. The price and availability of insurance can affect the property value. If insurance is unavailable or if the cost of insurance is really high, that's going to affect the value of your property, which is most people's largest asset if they're a homeowner. An analysis of the data by Insure Our Future found that California's non-renewals could be costing homeowners in California between 9.87 and 32 billion in property value loss as a result of the 100,000 non-renewals in California. So property values in California could be dropping, which isn't great for our economy. Senator Sheldon Whitehouse, who's a senator from Rhode Island, he has raised the red flag in Congress, saying that the failure to deal with climate change is affecting whether families can get homeowners insurance, which threatens their ability to get a mortgage, which spells trouble for property values in climate-exposed communities across the country. And so there are growing fears that these kinds of climate-related shocks to the home market could trigger a 2008-style financial crisis where insurers and banks abandon hard-hit communities because their home prices are declining, and there are accelerating foreclosures and delinquencies, which would affect mortgage-backed securities, just like in 2008. What makes this more concerning is that, as observed by a Financial Times editor, unlike other financial disasters, the underlying cause of this one is actually physical. It's not financial, which makes it unclear how it will ever end. So with that, that is our explanation of the problem. That is how climate crisis is driving an insurance crisis. And I will hand it over to Corey to explain how we got here and the role that big oil played.
Thank you, Chelsea. Is this on? Yeah, there we go. Do you have the clicker? Thanks. All right. So we're experiencing an insurance crisis that's being caused by the climate crisis. And the climate crisis was in large part caused by big oil's deception. If we go all the way back to the mid-1960s here, this is the American Petroleum Institute in an internal memo and presentation to its members. Its members are the biggest oil and gas companies that we know, the Exxon, Chevrons, Shells of today. They're predicting there that the burning of fossil fuels could cause marked changes in the climate. There is still time to save the world's peoples from the catastrophic consequences of pollution, but time is running out. So 60 years ago, they were saying their product is going to cause potentially catastrophic consequences, and even then, time was almost running out. And this isn't climate advocates saying it or even public interest lawyers saying it. This is the American Petroleum Institute, the main trade association for oil and gas industry. Now, I'm not going to show you all the documents that have been uncovered by investigative journalists and mid-public and are now at the heart of litigation that's underway. But for anybody who was here earlier today and saw the Power of Big Oil documentary, you'll recognize this scientist here, Ed Garvey. And Exxon in the 60s and 70s and 80s had some of the best scientists in the world. And they were, in the 70s, tasked with exploring and researching what they called the global warming issue. As Garvey says here, the issue was simply how soon and how fast and how bad it was going to be. It wasn't an if, it was a when. They knew their product was going to cause a climate crisis at some point. Another research memo from Exxon a few years later in 1982 said that preventing global warming, quote, would require major reductions in fossil fuel combustion. So they knew that to avoid the crisis, they would have to sell less of their product. But would they be willing to do that? Would they be willing to give us that information so we as a society could make that decision? Well, what they first did is they hardened their own infrastructure. They raised their oil rigs because they knew the seas were going to rise. They took out patents on new drilling equipment that was going to be able to be used in the Arctic because now it was going to be accessible to them. So while they themselves were using this internal knowledge to change the way they did business, to harden their infrastructure against the changes they knew were going to come, they launched a deception campaign. They did not tell us about the harms their product was going to cause. I mean, really, if you think about it, it is the most successful campaign of deception I think we've ever seen in human history. It was run through a armada of front groups. It was run through universities that they funded. It was all about sowing doubt around an issue that internally they had no doubt about. This is in the 1990s. This is public marketing put out by Mobile. This is the science of climate change is just too uncertain to do anything about. We don't know enough about it. It's the 90s, whereas in the 60s they knew, 70s they knew, 80s they knew. This continued really in the 90s, 2000s. We saw a lot of these advertorials they would take out in the New York Times every week. It would look like an op-ed or an editorial, but really it would be written by the industry just to sow this doubt, to try to muddy the water, to try to delay action so they could maximize their profits. Now, it's harder for them to just use straight denial. So what we've seen in the 21st century is a lot of this. Who here has heard of their carbon footprint? Yeah, we all want to do what we can individually to emit as little greenhouse gas as we think we're responsible for. Well, guess who came up with the idea of a personal carbon footprint? BP and their PR firms. It's not their fault that we're having climate change, it's your fault. So this deception continues. It looks different than it did, but we see it now today. Primarily, we see it in the false solutions, right? Okay, maybe we have a problem, but don't worry about it. We're gonna fix it. We're gonna transition to natural gas, which is really clean, despite the fact that methane is actually 80 times worse than carbon dioxide. Or we're gonna invest in CCS, carbon capture, despite the fact that it has not been proven that you can scale it up and capture that carbon. So this shifting of the deception is happening even still today. It looks different, but it's the same. Okay, sorry. Getting back to the insurance industry now. Even back in the 1970s, at least one major insurance company, Munich Re, the world's biggest reinsurer, so the insurance company that insures the insurance company, put out a report where they noted that they are already seeing the impacts of climate change. The company published a paper noting the rising temperature of Earth's atmosphere was due to the rise of CO2 content in the air, causing a change in the absorption of solar energy. In this 1995 Shell report, they cite another Munich Re report from '94. The climate signal has arrived and is evident from the mounting compensation claims from severe storms and floods. So the insurance industry, at least parts of it, also knew this was going to happen. And here in the mid-90s, the fossil fuel industry acknowledges the beginnings of the insurance crisis we're seeing today. Now again, publicly, here in '95 and years later, they're saying it's too uncertain, but privately they know it's happening and it's going to have this cascading effect. One crisis will lead to another. Okay, so the insurance industry is continuing to invest in fossil fuels. There's 12 major insurers that have restricted homeowners insurance in California, and they often cite the climate risks as a major factor, the ones that Chelsea just detailed. One analyst has concluded that these 12 insurers collectively have an estimated $113 billion of investments in and $3.6 billion of underwriting income from fossil fuel companies. So the very driver of the climate crisis that's causing these insurers to not renew or to raise rates for you are investing heavily still, even today, in the industry causing it. Okay, so that leads then to something a little more hopeful. What do we do about it? Who should pay? Who's responsible for these crises? How do we get ourselves out of this, or at least through it? I'll kick it over to Chelsea.
So there is some relief available. Several states, particularly in the southern US, have started to implement state programs to help homeowners fortify their homes so that they can stay insured and they can keep their insurance costs low because they'll be more resilient to the extreme weather. The kind of pilot program was implemented by the state of Alabama. They are granting up to $10,000 to homeowners to fortify their roofs so that they will be protected from wind damage from the hurricanes that are affecting the Gulf Coast. A major goal of the program, of course, is to lower insurance rates across the state. Louisiana has adopted a very similar program. These are states that are recognizing that extreme weather is starting to impact the availability of insurance, and it's starting to impact their home markets. The property values in those states have dropped dramatically due to extreme weather. These measures are a starting point to help ease the harm of climate change on homeowners and folks who are facing these harms, these costs. But they're really just a Band-Aid, and they're being propped up by taxpayers, the very people who are experiencing the harm in the first place. So not only are everyday folks paying for the rising costs of insurance and the losses due to climate change, but now they're also funding the state programs to try and solve it, which we think is not the right solution. The question that we pose in this presentation is who should pay? The fossil fuel industry, as Corey just laid out, knew what was going to happen. They knew that this insurance crisis would come from the climate crisis that was being caused by their products, and they lied to the public about that problem. They should be the ones to pay for this damage. The global insurance industry paid out an estimated $320 billion to cover damage from weather disasters last year, which sounds like a lot of money, but the fossil fuel industry brings in $3 billion every day. They should pay. I will hand it over to Corey to talk about some of the ways that states are getting these folks to pay.
Yeah, so what we've already seen for the last 8 years is some states, including the state of California, file lawsuits directly against these major oil and gas companies. And they're seeking damages. It looks a lot like the tobacco litigation, brought under public nuisance theories, consumer protection statutes, even some RICO claims, where they're saying we are having to change, modify, reinforce our infrastructure in X municipality or X state. 10 AGs have brought these lawsuits. And big oil, you should pay for that. So we've seen some states and municipalities go to the court directly to sue big oil. But a lot of those cases aren't mentioning the insurance crisis in there. They're not claiming as damages property taxes that they're no longer getting because the properties have burned or no longer can be insured. So it's right now a separate issue of getting the money to address the insurance crisis. And we've seen over the last few years some different states try some different ideas. They are the incubators, right? So in Connecticut, in 2023, and a lot of the major insurance companies are headquartered in Connecticut, and they have seen the ratepayers there have seen a 16% increase in the average insurance rates over the last couple of years. They proposed, I think, a really interesting idea where any insurance company that is underwriting fossil fuel companies or fossil fuel products will get a surcharge levied against them. And that surcharge, the funds, the proceeds from that fee, would be split between state climate resilience projects and programs to help lower and middle class insurance ratepayers be able to afford the rising insurance premiums. So that's one idea we saw out of Connecticut. It did not make it out of committee. Hawaii, just a few months ago, became the first state to explicitly endorse the idea of the fossil fuel industry bearing financial responsibility for the rising costs of insurance. They passed a resolution through their House and Senate that said as much. The main sponsor of that resolution, Senator Chris Lee, we're trying to get climate effects addressed by those folks who are knowingly contributing to the problem rather than the average family who is paying quite significantly. I expect we'll see more legislation out of Hawaii, but this resolution, I think, is a nice start. Finally, here in California, San Francisco's own state senator, Scott Wiener, last session, introduced Senate Bill 222. This bill, really was coming on the heels of the unprecedented wildfires in Southern California, where 10,000 homes were destroyed, 30 people lost their lives. And as Chelsea detailed, the state insurance costs were really out of control. This bill had a few really interesting pieces to it. First, it would have allowed individual victims and access to the courts to sue the fossil fuel companies directly to recoup the harms caused by climate-fueled extreme weather events. Secondly, it would have allowed insurance companies and the state's FAIR plan to recoup losses from the major climate disasters from the fossil fuel companies. This would have helped stabilize the strained insurance market here in the state. Unfortunately, Senate Bill 222 did not make it out of committee. That said, I do think it started a conversation here in this state, at least in Sacramento, about this idea of who should pay for this crisis and what are we going to do about it. So I think we can expect to see more insurance bills that deal directly with the fossil fuel industry in the near future. So those are just some ideas that we've seen so far from states. Again, we hope that this is getting the conversation going. We hope to see legislators really put their minds to this, think creatively, and figure out some sort of solutions that will unburden the ratepayers who really cannot take any more of these rising premiums. They knew they lied, they should pay. Thank you.
Thanks for a marvelous presentation. We have time for a Q&A. If anyone has a question for our presenters, please raise your hand and I'll bring a microphone to you.
Thank you. I don't know if this is a question, but a comment. I noticed my auto insurance went up 50% from last year. No change at all in my driving habits or in the policy coverage. And when I try to compare it with some other insurers, it's pretty much the same thing. It might vary $100 here and there. So I'm just wondering where that extra, 50% is going. If I knew it was going to something useful, such as supporting FAIR or something like that, I'd be okay with it. But I think what they're doing is kind of cost shifting. They're probably trying to hit the auto insurance policies for as much as they can if they can't get it from coverage of houses.
I think you're probably right.
Yes, big oil should pay, but also if we're just continuing to ensure people to stay in homes that are in areas that will be increasingly hit by hurricanes and fires, at what point does it stop making sense to incentivize people to be staying in those places? And what other ways would you suggest we tackle that one?
He's giving. Okay, I get to take this one. So, valid point. This is a relatively complex problem, and the solution to that problem is in zoning and permitting and new building. A lot of places are expanding. Metropolitan areas are getting bigger, and it is another problem for the legislature. It's an issue that they should be looking at as they're figuring out how to solve this crisis. So
Relocation is tough. I
Yeah.
mean, we've seen it in some villages in Alaska, seen it with some communities down in Louisiana, and it is really hard when people have ties to a land, be they ancestral or spiritual or otherwise. That said, this is a policy issue that I think we, as a nation and really as a world, are going to have to grapple with.
The climate coalition groups, are they mainly against drilling oil because of the emissions that they emit once they use the oil, the fumes they emit, and also because drilling oil, they could fossilize the trees?
I think the primary concern is the greenhouse gas emissions that are emitted when the oil is burned. Yeah.
Does it fossilize the trees if you take out too much oil from the forest?
That's beyond my expertise. I'm not sure.
I heard something like that.
We have a question back here.
Just wondering, in the California where, something was actually introduced, when it didn't make it through committee, do you think that that's because the lobby of the big oil has such influence? And, what do you do about that? Because lobbyists are putting people into office.
Good question. Yeah, I watched the committee hearing online, and it was pretty remarkable how many labor folks from unions that the industry got to come and stand up there and testify and say 2 words, vote against this bill, under some really half-baked theories that it would somehow hurt labor, hurt jobs, whereas, of course, in reality, it would have helped those union members as much, if not more than anyone. So you're right, the industry mobilized very strongly in opposition of that bill, and it was pretty clear that they mobilized a lot of their resources and support. But I think maybe next time we see one of those bills here, hopefully the other side can lobby and get out more grassroots support.
I know that we do a lot of things by ballot initiative here in California. Have you heard anything about going that route? Is that more viable than going through the legislature?
ballot initiatives are very expensive. And when we have a very powerful opponent, they're relatively easy to knock down, especially when our opponent has all the money in the world. But I mean, that's the short answer. There have been great ballot initiatives on a lot of issues related to climate change and plastic pollution. Yeah, they're hard. They're tough fights.
What is the actual dollar amount of the reserves of the FAIR Plan in California right now?
Ooh, good question. The risk is 650. I'm not actually. I think the reserves are much less, around less than $1 billion. Because this year there was over $1 billion from There's over $1 billion in damage from the wildfires in Southern California. Sorry, I'm just drawing on the library of my brain. I think there were about $6 billion in damages from the Los Angeles wildfires, and there were about $4 billion in the reserves. So this year was one of the first years in about 30 years that the reserves were exceeded due to the Los Angeles County wildfires.
Wow.
Those numbers aren't perfectly exact, but somewhere around there.
I had a question for the presenters. I believe one of you mentioned that San Francisco and Oakland had launched lawsuits, and I think that was maybe 2018, 2019. Was any progress made in those? Are they ongoing?
They are ongoing. They were some of the first filed, actually 2017, I think. And amazingly, the motions for dismiss still haven't even been decided in those cases. And that's because the defendants removed them from state court where they were filed under state law to federal court. And long story short, actually the federal district court ruled in defendant's favor, went up to the Ninth Circuit. Ninth Circuit overruled that district court, went back to the Ninth Circuit later. Eventually it's been remanded back into state court, where they're, I think, briefing the court now, but even haven't gotten through the motion to dismiss yet.
Thanks. Other questions?
From how much do home insurance usually compensates for homes for wildfire and flood-related causes, climate change crisis?
Totally depends on the policy. If you pay a higher premium, typically for a higher coverage, your deductible might be, 10% or something. But it totally depends on the policy. I don't know exactly.
If there are no more questions, I wish to express thanks on behalf of the library to Chelsea and Corey, and perhaps you can come back another time. Thanks for a very informative and marvelous presentation. Please.
Thank you, John.